Hello and welcome back to my channel. My name is Lissa. I'm a certified financial planner and an accredited financial counselor helping you learn more about money. In today's video, we're doing a different format today. I don't have anything outlined or scripted, but I am going to go through 21 questions that I have gotten in my comments on both TikTok and YouTube that will... See, not scripted. My phone fell. 21 questions that you all have been asking about various aspects of finances. Now, I've been gathering questions for a long time. Some of these are like over a year old, so I apologize. Moving forward in the future, if you have any questions, definitely drop them in the comments. And if you guys like this format, I'll do more videos like this. So let's jump into the first question, which says, would you make a video on what to do and steps we should take for stay-at-home moms? Husband is investing in his 401k, but what should I/we do in terms of saving and investing? Now, the first thing is I like the fact that she said, what should I/we do in terms of saving and investing? Because for someone who's a stay-at-home mom, you have to know that your partner needs to look out for you, right? You're covering bases at home, so you want them to be able to help you. Now, there are a lot of different options that you can look into, so there's not actually one way to go about this. But for example, if your husband has an income, you can contribute to an IRA. There's a thing called a spousal IRA. It requires income, so it would be your husband or your spouse providing the income for it. So it's something you guys need to talk about, but you are able to contribute to an IRA. Now, from a broader perspective, when it comes to finance in general, if you're a stay-at-home mom, right, not only are you not earning money directly in your name, but by not focusing and making progress in your own career, you are putting yourself at potential future financial risk. So there are things to manage risk like that. For example, life insurance. If you're a stay-at-home mom and your partner is the breadwinner, you want to make sure that you guys talk about insurance and being a beneficiary in case something were to happen to your spouse. Another thing, if we just rewind real quick, that I learned because I recently got married is understand what the laws are in your state if you did not end up getting a prenup or a postnup. Here's why it matters, right? Even if you don't plan on ever getting divorced and you don't see that ever happening, it's less about divorce and what would happen after that. But understanding your state's laws is more about understanding how assets are treated by being married. So for example, there are some states, like the one I live in, California, that are considered community property states. Now, I'm not a lawyer, but my understanding of it, especially in my own situation, is that money that I acquired before the marriage and money that my husband acquired before the marriage stays what is called separate property, right? His stuff stays his, my stuff stays mine. When you get married in a community property state, what one spouse earns or acquires during the marriage is considered community property, meaning it's shared. Now, does that necessarily mean you have access to your spouse's bank account for that cash? No, logistically, you guys have to figure out your own money management system. But in the eyes of the law, we're talking about who owns what. So if you didn't get a prenup to outline who owns what, both before the marriage and during the marriage, it's something that you want to just understand now. Now, I know I'm going on some tangents, but I want to give one more concrete example. In this question, this person said that their husband is contributing to a 401k. If that 401k is completely in the husband's name, it can be looked at differently depending on whether you are in a community property state or a common law state. Again, I'm not a lawyer, but it's something that you want to look into because it basically states whether or not your husband's retirement money is completely his, or if at any point you would also have technically a claim to it. All right, I gave a long answer. I promise not all 21 of these are going to be that long, but the quick summary is if you're a stay-at-home mom, talk to your partner about your own retirement, such as a spousal IRA or other options. Talk about insurance and just plan together what retirement is going to look like for the two of you while also doing some risk management planning as well. Next question. What personal finance book should I read? I'm a novice and I am in my 30s. This is a great question. There are so many to choose from. I will link a video up here with some of my recommendations, but ultimately I would just say grab one and read it. For beginners, especially for women of color, I particularly like the Clever Girl Finance books. Get Good with Money, Finance for the People, Money Out Loud, Cultura and Cash, and Yo Quiero Dinero. Other popular books, Broke Millennial, I Will Teach You to Be Rich. But again, grab one, read it, learn some things. If you didn't like that person's style, try another one. Next question. Please advise how much one must have to start investing in the stock market. Literally, nowadays you can start with $1. There are micro investing apps. There are ways to buy fractional shares. This is all different terminology that you can look up and see what platforms and services offer them and just start. One version of micro investing are those roundup apps where if you purchase something, you round up to the next dollar and use that loose spare change, like 55 cents, and invest it. Now, even though that's not a lot, what it can do is help you get into the habit of investing. If you have more money to invest, $50, $500, $5,000 on a regular basis, that's great too. You can always open a brokerage account. You can look up robo-advisors. You can look up a financial advisor. There are different ways to get started. And nowadays you can literally start with $1. I have 10K, but it's tied up in savings accounts. Do you think we need the 1,000 pounds or 3 months bills to be easily accessible? So I actually don't know how accounts work in the UK. I'm assuming this person is in the UK because it has the pound symbol. But generally, yes, you want your starter emergency fund or your emergency fund to be relatively accessible. Savings accounts here in the US, typically you can get your money out within a day or two. Sometimes there are limits to how much you can take out at once. Sometimes there aren't. You want to be sure that you have access to at least a month's worth of expenses readily available, if not same day, then definitely in the next day or two. It doesn't necessarily have to be available right now at this second, and that's usually the case when you have like an online savings account. Typically, to get money out, you have to move it from that account to a different checking account, and then you can withdraw it. But typically with emergencies, unless you're like doing something shady or you're a drug dealer or something, typically you don't need money the same day, right? Oftentimes, if it's something like a bill payment or your rent, you can call up your lender or your landlord and ask for a couple days of an extension. If you have access to credit cards, you don't want to get in the habit of building up a credit card balance, but you can use a credit card to buy you time. And in that time, you can get the funds out of wherever they're sitting. So to summarize, yeah, you want some money easily accessible. It doesn't have to be a ton, but at least a month's worth of expenses or a few months worth. All right, this is a funny question. It's about me, not about money, but are you mixed? I am full Filipino. I'm a mixed Filipino. I am half Tagalog and half Ilocano, but both my parents, as far as I know, are Filipino. Now, when I did 23andMe, it did show that I had like 7% European ancestry, and as you probably know, the Philippines was colonized by Spain for a long time. So some of my DNA traces back to Europe, but me, full Filipino. All right, please explain to me how a person's home or primary residence can be an asset when, by definition, it is a liability. A loan is taken out, you're talking about a mortgage, a loan is taken out with interest owed, which is debt. A person spends money on maintenance, and once the loan is paid off, there are property taxes and continued maintenance. As far as increased value, that is only as good as you have people who can afford that increase in value. Okay, so I don't even have the full comment here, but I understand what this person's trying to say. So when we say asset, we are saying that you own something of value, at least from a financial sense. Having an asset means you own something that has the potential to make you money. When we're talking about a home, there are two primary ways to make money from a home. You buy it for this amount, it grows in value over time, and then you sell it for this higher amount. And whatever that difference is your capital gain. Now, yes, while owning the property, you are paying maintenance and property taxes, etc., and that can eat into your overall profit from it, but that doesn't take away from the fact that it is still an asset. Now, the other way you can make money from an asset like real estate is through income, through rental income, cash flows. So if you own the home, you rent it out, you get paid rent. Like, yes, you still have to pay the mortgage if you have a mortgage and pay property taxes and all of the things that are tied to you as the owner. I can understand why someone would say, like,
how is it an asset if sometimes it doesn't make you money?
So we use the term asset to kind of represent ownership. Ownership of property, ownership of a stock, ownership of cash in your bank account. It doesn't necessarily equate to good investment or profitable investment in the long run. So a home is interesting because if you take a mortgage out, like the home's value itself is your asset, and then the mortgage, what you owe on it, the debt, is a liability. The two offset each other, and you still should have some equity in the home. Sometimes you don't because your mortgage is bigger than what you initially paid for it. That can happen. It's considered negative equity and it's not a good situation. But when we're talking about like logistically of understanding your net worth and what do you own minus what you owe, the property itself is still considered an asset and the mortgage is still considered a liability or a debt. And the one more thing I want to point out, now that I'm looking at this comment a little closer, is their concern with a person's home or primary residence being an asset. So forget the cash flow part where I was mentioning renting it out. I understand the sentiment completely. A lot of times when people buy a home to live in it, it has potential to lose them money. You're paying a ton on interest if you have a mortgage, property taxes, maintenance, all the things that this person mentioned. And if you never intend to sell it ever, then you will never make a profit out of it. The fact is, though, owning it and having equity in it still gives you some financial power. If you have equity in the home, you can potentially get access to a line of credit based on your home's equity. If hit the fan and you lost all other money you ever had, you could sell your home and still have money out of it because it is still an asset that you own. And what is an asset? An asset is something you own that has monetary value. So I'm not mad at this comment. I get what they're trying to say, and I hope I explained it well. Maybe this calls for like an entire video to talk about this, but if you're still confused, let me know in the comments and we'll follow up on it later. I would love to feel like we're making the kind of money that we're making, but I still feel like I did when we were broke. How do I change my mindset? This is a great question. Because this is like what I love talking about on my channel is if you don't feel good about your money now, how are you going to feel good about it when you're making twice as much, 3 times as much, and you have so much more? So there's 2 things that have to happen. 1, you have to get your finances in a good place logistically, right? Pay off debt, save, invest, spend less than you make, and think about your financial future as much as you think about your current self. But you also want to get your mindset in a good place. I can't tell from the comment what kind of a lifestyle this person is living, but if you feel the same when you were broke from when now you have way more than you did, it could mean a couple things. It could mean you've inflated your lifestyle, and so if you're broke, right, you're making very little and your expenses are here, they're about the same, you're gonna feel like things are tight. If you're making a lot of money but you've inflated your lifestyle, you're also going to feel tight, right? Nothing has changed in terms of tightness, except maybe you live in a bigger house, have nicer clothes, etc. So that could be one potential issue going on here. Another one could be purely on the emotional and mindset side, which is, do you have a scarcity mindset? Did those years of being broke feel traumatic? Or did they write your narrative, your money narrative, in a way that you can't see past? So for example, a lot of times when people are broke, they have a narrative where they feel like,
I'm always going to be broke. I'm always going to struggle. Things are tight.
And then when they finally have money, they are still stuck in that narrative because they lived it for so many years. Or maybe they felt that way when they didn't have money, and then they felt better when they had money. and then something happened in life that brought them back to having no money. So they don't trust the fact that life can be abundant. So here I am going on another tangent, but in order to change your money mindset, it truly is a practice. It's about building a self-awareness. It's about being kind to yourself. And low-key, my beginner personal finance course, Hello Money Bootcamp, is something that will help, because I approach building wealth and finances not just from the logistics, but also from the emotional and mindset side. So there's not one answer, but learning more about yourself, building self-awareness, getting support maybe from a therapist or a financial therapist, and seeking out resources that help move you from a scarcity mindset to an abundant one. All right, next question. Is this only for women of color? So I recently changed my channel name to my name, and I wrote a post about that in case you're curious about why. But I still own the company and brand called Wealth for Women of Color. And no, it's not only for women of color. If you've ever heard me in my past videos say, it's for everyone. The reason I named the brand Wealth for Women of Color is because I myself, as a woman of color, as a child of immigrants, as someone who didn't grow up around investing, I always ignored it. I thought it wasn't about me. I thought it wasn't for me. I thought I just had to get good grades, get a good job, make some money. I never thought to invest because I didn't think it was for me. Wealth being in the same sentence as women of color is something I want to normalize, especially for women of color who have never thought that they could make six figures or build their net worth to $1 million or have multiple streams of income. I want that to be normalized, but I want to wear that loud and proud so that if someone is scrolling through on Instagram and they see that and they're a woman of color, they automatically know that this content is for them. They don't see the word stock market and get scared of it. Instead, they know that it is possible and they just need to find the resources and the voices that speak to them. So no, not only for women of color, everyone is welcome, but I hope you guys understand that mission because it is very important to me. All right, after paying off all debt, including the house, what would you recommend doing with the rest? This is a nice problem to have. If you have paid off all your debt, including your mortgage, and you have a lot of extra money on a monthly basis, you can do multiple things. You can take a small amount of that and increase your lifestyle if you want to, but save and invest. Think about the future. If you no longer have debt, you're no longer paying for things in the past. If you no longer have anything you need right now in the present, throw it all to the future. This could be actual retirement accounts that you can't access till a certain age, but it could also be other types of investments that help grow your wealth and help you reach goals that you might not even know you have yet. But again, this is a great problem to have. It's as easy as save and invest. Do you have any books to recommend for starters? I already mentioned that earlier, and I didn't realize there was two of a similar question, so I'm gonna just go ahead and breeze past this. I started to use credit cards to pay for most things, and the bonus points are adding up. Do you recommend any specific credit cards? Long story short, I do not recommend specific credit cards because, one, I'm not getting paid for it, but two, there's so many different credit cards that fit different goals and situations. I can tell you what I have. I have an Amazon Prime Visa card because I do shop a lot at Whole Foods and on Amazon, so I get 5% back on those purchases. I also really love American Express. I really love their benefits, their perks, and I focus a lot on travel hacking when it comes to credit cards. The reason I can't recommend specific cards is because I don't know what your goals are. So for some more generic guidance, I would think about what you want out of your cards. If you are already in a good place where you're not carrying a balance and you are now being strategic about credit cards, is it travel you want to optimize for? Is it cash back? What things do you normally purchase? And also, do you know how much you run through a credit card in a given year? Once you know that data, it'll help you make decisions on what credit cards to look at. I have a lot of friends who do not believe in paying for a credit card, $200 fee, or my credit cards have like a $700 fee because they're like, that's a waste of money. But I've calculated the math on my own usage of credit cards. I get more than that back in rewards and perks and value. So to me, the fee is worth it, but you won't know that until you know how much you can potentially get out of a credit card. So it's a great exercise to look back at your credit card spending the last 3 months, 6 months, or a year to get a gauge of how much you actually use your credit card for. That can tell you how much value you're getting out of a credit card based on the perks and cash back that you get. And that can tell you if you can look into the next tier of card that maybe has more rewards but might cost more. Are you a financial planner? I'm guessing that's what it means. Or if not, do you recommend any places we can find good personal financial planners? I am a certified financial planner. I am still in the works of building my financial planning firm. So I don't currently take financial planning clients. I only do financial coaching right now. That said, if you're looking for a financial planner, and for those who don't know, a financial planner is someone who takes a look at your entire financial life. They get to know your life goals and your financial goals, and then they help gear you in the direction of what to do, what to prioritize, where to invest money so that you can reach those goals. I'm biased, but I think if you're going to look for a financial planner, look for someone who is a CFP professional, a certified financial planner, and you can do that at a website called letsmakeaplan.org. All right, I'm going to skip to the question. Can you give some advice on how to break into larger tech companies? Keep in mind, I have not broken into a tech company or gotten hired by a tech company for over a decade. My last full-time job, I worked at Google, and I worked there for 11 years until I left to start my own business. That said, one of my really close friends is in HR at a tech company, and I have a lot of friends and my spouse who work in tech. And there are a lot of ways. Network, build your network, go to networking events, reach out to people on LinkedIn, ask for informational interviews, and upskill, build your skills. If there's something specific you know you can offer to a tech company, learn a skill, get a certification, do something to help you stand out. But I think it's very possible to break in by building your network, meeting people, and there's always a chance that someone can help you break into tech. Now, one more thing when it comes to breaking into tech. The way I broke into tech many years ago was I took on an entry-level role. I had a graduate degree, I had a master's degree, and I currently worked at a broadcasting company. And when I got hired at Google, I took on the role of an administrative assistant. Now, at the time, I felt like this feels like so below me because I had already had this work experience. I felt like I was very educated, but it was my way in. I got hired, entry-level position, and then I climbed the ranks. I stayed in that role for, I think, just under 3 years. But the upside of working entry-level at the tech company was I was actually making way more than I was making in my last job. I was happy. I cared about the money. Another way to do it is to find roles that even if you think you're overqualified, go for those. If you are overqualified, they'll see it as soon as you start working there, and maybe there'll be a path to something higher up, something more challenging. It's just another option of how you can get your foot in the door. How long did it take you to become accredited? So this is in regards to me being an accredited financial counselor. So the program I went through, the website is afcpe.org. It is the Association for Financial Counseling and Planning Education. And a lot of people that end up becoming AFCs and financial counselors do a lot of nonprofit work, counseling for military folks, but also a lot of them are great financial coaches. So you don't have to have an AFC credential to be a financial coach, but I think it is great to have that, not only because it makes you stand out, but because you learn some structured curriculum. So I could tell you by looking in my email, I registered to start my certification in August of 2022. And I completed the certification in April of 2023. So less than a year for me. There were a lot of hours that I had to get done, but I was getting my CFP certification at the same time. So I was doing a lot of learning and able to use a lot of those hours for both credentials. So it took me less than a year. You could probably do it faster than I did, but also it depends on if you work full time. I already knew a lot of the curriculum, but it was great to have it in a structured format, and it was all online, self-paced. So that was pretty straightforward. What usually takes people the longest is getting the certification hours. But one upside of getting a financial credential, such as the AFC or becoming a CFP professional, that one takes a lot longer. But what I think is great about these is not only are they an investment and a way to upskill and explore a potential future career. But even if you don't end up becoming a financial professional, you learn so much that you can apply to your own life, which I think is priceless. It costs less than a college degree. So I love continuing education and continuing to learn in your adulthood. All right, we got a couple more to go. What accounts do you recommend or suggest a married couple have? Well, again, like I said earlier, this is something I can't give direct advice or guidance on because I don't know your specific situation. Every couple is going to have their own system of how they do things. What I do in my own life is something I can share, which is both my husband and I have our own individual accounts, and we also have joint accounts. For us, the majority of our money goes into the joint accounts, and then we have small amounts that go to ours that we can use for whatever we want, including secret gifts for each other and things like going out with our own friends without the other person. So when it comes to banking, it's gonna require on how you guys manage your funds. But like we mentioned earlier in the video, something else you want to talk about with your partner is your guys' plans for retirement, because how you guys invest money as a couple together is going to determine what the future of your guys' life looks like. And that can be in retirement accounts as well as outside of retirement accounts. So you're going to want to figure out what you guys want to do together and separately when it comes to investing. But like I mentioned earlier in the video, you also want to understand how property ownership works in your state. Does it matter how much we invest in an HSA? An HSA, oh my God, I just bit my tongue. An HSA is a health savings account. And this is technically an investment account, and it's different from a flexible spending account. Both are typically employer-sponsored accounts. You can only typically have one or the other. It's different from an FSA in the sense that you take it with you after the job. An FSA, you put money in it and you got to use it within the year. An HSA, you're putting money in, and similar to a 401k or retirement account, it's going to grow in value and it's going to be yours to keep into the future. So this question in does it matter how much we invest in an HSA? This is kind of not a straightforward question or answer. Like technically it doesn't matter. It's similar to a 401k where you can put as much as you want or not at all. The thing is, in order to be able to have a health savings account, you need to have a high deductible health plan, which means you're opting in to health insurance that has a high deductible. And for people who go to the doctor regularly, that's going to equate to more money out of your pocket now because you have to pay for things out of pocket until you hit your deductible. But the gain you get is in the long run with your HSA money growing. So if you opt into a high deductible health plan and you're paying a lot in medical expenses now and you're not contributing anything to your HSA, you're kind of losing out on the benefit of the HSA. That said, there are limits to how much you can contribute to an HSA. It is a very popular account for putting money aside that can grow tax-free because you put money in it, that money is not taxed. If the money grows in the account, it's not taxed. And if you withdraw it and use it specifically for approved medical expenses, it won't be taxed as well. So if you put money in an HSA and you use it for medical expenses, you're not going to pay taxes on it, which saves you a lot of money in the long run. Because it offers such great tax advantages, there is a relatively low limit to how much you can put in it. So for 2025, the max contribution you can put in an HSA if you are an individual, as in single, is $4,300. That's not a lot of money compared to like $23,500 that most people can put in their 401ks. So back to the question, does it matter? There's no rule on how much you can and should put in it, but you want to take into account that if you're opting into a high deductible health plan and spending more cash on medical expenses now, you want to reap as much of the benefits as you can from the HSA, which means putting as much as you can in it. So I hope that makes sense. With a CD, don't you have to have the money ahead of time as opposed to making regular deposits? A CD is a certificate of deposit, and the answer is yes. Typically, if you are comparing, like, do I want to put money in a savings account and get interest, or money in a certificate of deposit and get interest. The difference with those two is with a savings account, you can put money in and take it out tomorrow and still reap the benefits of getting interest for as long as the money is in the account. For a certificate of deposit, you have to put money in, typically in a lump sum up front, and it has to stay in there for the length of the term in order for you to reap the benefits of interest. So yes, you need to have the money ahead of time as opposed to making regular deposits. And this is why often, not always, but often, you can typically find CDs that have better interest rates that pay you better than a savings account. Sometimes that's not the case, but you want to look into it closely to make sure you are getting the best bang for your buck. Is there a way to invest in stocks that's more ethical and aligns with my values than investing in things I'm ethically against? Yes, there is. Now, I'm not the biggest expert in this, but because it does get confusing, there are different types of socially responsible investing out there. I do have a book recommendation for that. It's called Activate Your Money by Janine Firpo. Met her, amazing, smart woman. And this is a great beginner personal finance book if your goal is to put your money in places that align better with your values. How does one get involved in real estate with limited funds and a mediocre credit score? There are real estate financial instruments such as REITs that you can invest in that don't require having good credit at all, and you can benefit from real estate investing, but it doesn't mean you actually own property. You can also work on building up your credit score or find a lender who will work with you if you can save enough money to put a down payment on a property. And even though that might take longer to work up to, it is an option. Another thing that some people do is pool their money together. Oftentimes, when you're buying your first property, most people don't want to do it with someone else, a friend, a partner, a family member, because there can be complications with that. And I agree. But it is an option. If your credit's not great and you have limited funds, but you can utilize the power of someone else's credit and their funds along with yours, and if you can come up with a good agreement between the two of you of how you're gonna manage it, that could be another option as well. And finally, there are first-time home buyer programs that can sometimes help people put down a lower down payment, which means being able to buy real estate with less funds and with mediocre credit. Where do you start investing? What apps or things should you look into? I'm going to link another video up here about 3 ways to get started. I can't tell you exact apps because there are dozens and dozens of them, and I haven't used them all, so I can't really tell you which one's like the best one. I would just say get started. For traditional brokerages, people typically look into places like Vanguard, Fidelity, Charles Schwab, but there are also a lot of fintech apps and micro-investing apps and robo-advisor apps that you can look into. But definitely check out that video that I linked because that gives you 3 different paths to start investing if you are a beginner. And finally, is there a way to have a savings account for a short time and another one for long term with different banks? Yeah, the answer is yes. You can open savings accounts at as many banks as you want and have as many accounts as you want. The thing is, you want to make sure that your money management system is manageable, that you don't forget about accounts you have, that you understand the rules on all your different accounts. But if it helps you to have your money in different banks and to compartmentalize your money as short-term versus long-term, totally doable and totally worth a try to see if that works for you. All right, I hope this video was helpful, and until next time, peace out.